Happy Monday, everybody. I hope you had a great weekend. Today is September 29th, 2025, and this is your Monday market update. Now, let's recap last week and let's preview the week ahead. So sum up last week, let's say this: AI inflation's faded, inflation data heated up, and markets paused at record highs. All right, then let's fill in some details. Okay, after several weeks of powerful gains fueled by AI enthusiasm and dovish Fed hopes, stocks took a breather last week. Despite strong economic data and record level optimism in some corners, investors were reminded that even a soft landing isn't a straight line. With the September jobs report, a flood of Fed speakers, and a potential government shutdown looming, the week ahead could prove pivotal. So let's look back at what drove the markets day by day. Markets started the week on Monday on a strong note as NVIDIA announced a $100 billion partnership with OpenAI to build out massive AI infrastructure, a deal that reinforced the private sector stimulus narrative now underpinning tech spending. AI related capital expenditures are approaching 4.5% of US GDP. That's a level that has not been seen since the late 1990s. Now, I'm going to get to this comparison at the end of today's report, so hold on to that. Early losses tied to cautious Fed comments from Fed head Bostic, hinting just one more 2025 cut. That was way less than the market is figuring at this time. Those losses faded quickly as investors focused on dovish signals from other officials and enthusiasm around the NVIDIA OpenAI announcement. News that President Trump was set to sign the TikTok deal also boosted sentiment. The Dow was up almost 0.25%, S&P up nearly 0.5%, and the Nasdaq was up about 0.75%. S&P 500 closed just below 6,700 within striking distance of fresh records as investors again cheered another round of AI-driven optimism. Now, Tuesday brought a dose of realism. Strong U.S. PMI data confirmed solid growth, but Fed Chair Jerome Powell reminded markets that there's no risk-free policy path ahead, and he described equities as fairly highly valued. Now, recall some of the famous Fed Chair market calls. Irrational exuberance rings a bell. So if you remember all that. Additional remarks from Bostic and Bowman about labor market fragility and sticky inflation dampened hope for more rate cuts. Stocks did surrender Monday's gains as rising yields and valuation anxiety took hold. The Dow was down almost 0.25%, S&P down 0.5%, and the Nasdaq was down nearly 1%. Investors began debating whether AI enthusiasm alone could sustain such elevated multiples. The S&P 500 right now is trading near 23 times forward earnings. That's the richest it's been trading since early 2021. I refer you back to past videos. Valuation is a concern of mine, but as I've noted many times, it's not a good timing mechanism. Wednesday proved that AI headlines can't fight gravity. Markets opened higher after Alibaba unveiled a $50 billion AI investment, and Micron topped earnings expectations. Yet strong new home sales data reignited fears that the economy's strength could keep the Fed cautious. By midday, profit-taking hit tech, and sentiment data revealed cracks in some recent surveys. American Association of Individual Investors, their survey showed bulls rose to 41.7, but bears stayed elevated at 42.4. Advisors also seem to hit their most bullish stance all year, a classic contrarian caution sign. The Dow was down almost 0.5%, S&P was down 1/3%, and the Nasdaq was down almost 0.5%. Thursday brought hot data and a cold reception. The markets started in the red as the trio of upside surprises, durable goods, Q2 GDP revision higher, and jobless claims all trended lower, pushed yields up and rate cut hopes down. A weak 7-year Treasury auction, fresh EU fines on Google, and talks of new tariffs from both Washington and Brussels added to the caution. The Dow was down almost 0.5%, S&P down 0.5%, and the Nasdaq was off about 0.5%. Investors positioned for Friday's core PCE inflation data for clarity. Now, on Friday, the core PCE price index landed in line with forecasts, up 0.2% month over month, up 2.9% year over year, confirming inflation's slow glide, but little new relief. Meanwhile, Congress inched towards an October 1st shutdown as budget talks stalled, raising the prospect of delayed economic reports. Trading was cautious and volume was light headed into the quarter end. The Dow was up 0.2%, S&P up almost 0.2%, the Nasdaq was up almost 0.5%. After flirting with record highs early on, all three major indices finished lower on the week. The Nasdaq Composite and S&P 500 were down. The Dow was down 0.25%. Exactly, the S&P 500 was down about 1/3%, and the Nasdaq was down 0.75%. Now, before heading into this week, let's sum up last week with some key takeaways. First of all, AI optimism remains powerful, but it does face question about the returns on massive spending. Again, I'll get to that in just a second. Economic data shows resilience, that's durable goods, housing, labor, limiting the Fed's room to cut. Now, valuations stretch and breadth is narrow. Sentiment's also mixed. Advisors euphoric, investors cautious. Policy risk rising, possible government shutdown could delay the October data. Okay, the week felt like a pause, not a pivot, in a still intact bull market and a bull trend. Let's preview this week. Today, we're going to get housing data and Fed heads Waller, Hammond, Musalem, and Bostic. Tomorrow, we should see the beginning of the jobs parade of data. Now, remember, if we get a government shutdown, all bets are off since many of the reports will not be released. But tomorrow, we'll get JOLTS, GDP, we're going to get ADP. Wednesday, we'll get jobless claims and continuing claims on Thursday, and then September jobs report on Friday. Add in some earnings and even the delivery reports from Tesla. Watch closely, and this will give you another week to watch. Fed heads, in addition to the ones from today, will be Jefferson, Collins, Goolsby, and Logan. Now, before I close out, as I mentioned before, AI-related capital expenditures are approaching 4.5% of U.S. GDP, a level not seen since late 1990s. There was a great Wall Street Journal article over the weekend that pointed out some important facts. Now, normally I know this is getting a bit long, but since AI enthusiasm is one of the keys to this market, it is important to hear some details about what is going on. The current AI spending versus 1990s internet build out. Let's talk about scale and ambition. In recent years, leading tech firms have committed trillions of dollars to AI infrastructure, data centers, chips, energy, and more in what's being called one of the costliest building sprees in history. Now, in the late 1990s, telecom and internet companies similarly poured over $100 billion into laying fiber optic networks across the United States under the belief that demand would grow explosively. Now, overbuilding risk and speculative mindset, just as the telecoms in the 1990s overextended, building capacity far ahead of usage, today's AI infrastructure could face similar threats of overcapacity. Many of the new data centers and compute facilities may struggle to find sufficient utilization or customers. In the 1990s, excess fiber sat idle for years, and companies that bet aggressively on scaling quickly collapsed or were forced to restructure. Companies like Global Crossing or 360 Networks. Revenue mismatch and return expectation. Today, AI revenues are still modest, about $45 billion is estimated in 2024 for estimates, compared to multi-trillion-dollar infrastructure being built. To justify current investment levels, it's estimated that the industry will need to generate $2 trillion annually by 2030. That's a massive leap. By comparison, that's more than the combined 2024 revenue of Amazon, Apple, Alphabet, Microsoft, Meta, and NVIDIA, and more than 5 times the size of the entire global subscription software market. Now, by contrast, in the 1990s, the anticipation that internet traffic and services would explode drove the fiber build out, but many of those assumptions proved overly optimistic when usage didn't match capacity. Now, to be clear, there are important key differences and defenses. Proponents argue today that AI build-out is more sustainable than the 1990s internet run. Why? Cash-rich tech giants. Many AI hyperscalers already generate significant free cash flow, reducing dependence on borrowing, faster deployment and adoption. Unlike the internet, which required physical wiring and gradual build-out, AI tools can be deployed globally almost instantaneously. You also add greater integration usage potential. If AI truly automates white-collar work, the productivity gains could help recoup infrastructure costs in ways the internet's early monetization did not. And I bring this up, as I said, just to keep the conversation more than just rainbows and unicorns on one side and the doomsdayers on the other. With all that said, we need to watch the keys for the week. Those keys: government shutdown risk. This could delay the jobs or pending inflation reports. Yields. Any breakout above the recent highs may pressure valuations. And sector rotation. Watch for cyclicals versus mega cap tech for leadership clues. As always, I'll stay on this for you, so please stay in touch. For now, as always, keep your eye on the long-term plan and watch for more planning ideas on Friday. Keep planning and have a great week.